Well, Treasury yields are moving lower this morning to kick off a new month of trading after scoring its fifth straight month of gains in September. For more on what to expect from the bond market in the months to come, we've got Jeff Given, who is the Senior Portfolio Manager, co-head of U.S. Core and Core Plus Fixed Income at Manulife Investment Management. Great to have you here on set with us.
Thank you for having me.
Absolutely. So, I mean, as we are kind of like moving away from what could take place in the equity markets in the fourth quarter of this year, now you've got kind of a different scenario than we began the year with on the fixed income side. What is the biggest pivot that you're tracking there?
Yeah, it's really the pivot of what people expect for the Federal Reserve. It's been a bit crazy this year, to be honest with you. You started off, we were pricing in 7 cuts, and then all of a sudden we're pricing in almost no cuts, and now we're back to like 6 cuts. So I think that volatility is going to continue on what the market expects, really based on, the unemployment numbers that we think are going to be the most important thing. And, we're going to be watching very earnestly what's going to happen on Friday.
Jeff, when you take a look at some of the movement that we have seen in the bond market in the wake of the decision by the Fed, we did see a positive in the 2s and 10s here. Just in terms of, is that a trend that you think is going to continue, or are we going to see that steepening? And I guess, what does that indicate just in terms of an investment opportunity?
Yeah, we do think the steepening is going to continue. Historically, when you get to the end of Fed cutting cycle, you're going to see 100 basis points between 2s and 10s. Yeah. Now, that's when you're probably in a recession. I'm not so sure that's going to happen. So maybe it's 50 basis points this time, but we still have a lot of steepening to go. Not that surprising we backed off of it. We moved quite fast over the summer as we got ahead of ourselves a little bit.
Yeah, Jeff, do you think the bond market is still ahead of itself just in terms of what it's pricing in, what it's expecting the Fed to do versus maybe the more likely outcome at this point?
I do. I think that pricing in another 50 basis point cut in the next meeting and then another 50 basis points is a little bit much. Mm-hmm. I thought they'd go 25 this last meeting and leave the 50s for when they're in trouble. Mm-hmm. But I wouldn't be surprised if they dial it back to 25 in the next 2 meetings.
I mean, it's really been the depths of the cut that have caught the markets kind of flat-footed at this juncture here. So, I mean, it's really thinking about how the Fed will have to continue to show this kind of combined force and maybe only have one dissenter on a continuous basis, but be unanimous in their decision making. How might the bond market swing just based on the tenor that they sense, or at least the kind of unanimous type of sense that they're getting from the Fed at this juncture?
I do think it's really important for the Fed to be close to a unanimous, and it makes sense to have one dissenter out there, especially a governor saying, okay, maybe we don't need to go as fast. That's going to be the brakes on the marketplace, so to speak.
I mean, who wants to be that person? That's just like, all right, cool, I got the short straw, I'll be the dissenter.
Somebody always wants to be difficult, don't they?
But I mean, boring if everyone.
Right, but you were saying how important that is.
It is, because that's going to give the market more confidence that the Fed knows what they're doing going into the meeting and coming out of the meeting. And that signal, we think, is very, very important.
So I guess, how should investors then be thinking about this opportunity? Because there's so much uncertainty about whether or not we are going to see further weakening within the economy, what that risk of recession looks like, ultimately how that plays out for the bond market. Where do you see the most attractive opportunities right now in fixed income?
I think first, along the curve, it's not about just taking duration, it's taking the right amount of type of duration. So looking at that intermediate part of the curve is very important. We may not see 30-year yields drop a whole lot, or even 10-year yields drop a whole lot, but you could see that 5- and 7-year yields come down fairly significantly as that curve steepens out through the cutting cycle. And so I think, from a curve perspective, that 4 to 8 year part of the curve makes a ton of sense. You can get some added return there. And then sector-wise, agency MBS, that's where we're focused on to adding value away from just the Treasury market.
Is it still U.S. bonds that are most attractive, or are there other areas around the globe internationally that you're looking at bond buying opportunities?
Yeah, we focus mostly on the U.S., but I do think as the Fed gets through the cutting cycle that the dollar is going to weaken a bit. And so that's going to make areas like Europe and other developed markets look attractive, and potentially some emerging market countries as well.
Jeff, as we've been talking, we've been getting some headlines here just about a possible escalation here from Iran with Israel, and we've seen a bit of a reaction play out in the bond market, which is what I want to talk to you about. With bond yields right now tumbling, it almost seems like a knee-jerk risk-off type of reaction. I'm curious how you're evaluating that heightened geopolitical risk and the impact that you see that playing in some of that movement that we'll likely see.
Yeah, and I think that's the reasons that go into that intermediate space and buying the fixed income where nobody wanted to buy it the last several years, right? That is going to be that risk-off trade. It's going to create some stability in portfolios. So I would expect that to continue through here. Obviously the offset is the fact that the U.S. government doesn't want to stop spending anytime soon. But from a geopolitical standpoint, the dollar will be the safe haven. Treasury market's going to benefit from that.